Welcome to the session. Topic of this session is preparation of balance sheet. Many agricultural projects, they are having the industrial components, like the business organizations, the private organization or the public sector business organization, like we have the food processing agricultural organizations or agricultural companies who are involved in the value addition, food processing, seed sector companies are there, the biofertilizer the companies are there, and the fertilizer production companies are there, and various mill or processing activities are there. So these projects are having the industrial component or business component, like normal companies or manufacturing component. Even the large farmers, they also have the business component, or their financial performance should be evaluated as per the performance is judged for the other business organization or private organization, public sector organization. Like we have the tea farm, the tea cultivation farm, the coffee, the plantation. So they are the business commerce organization or commercial organization. So their financial performances should be judged as per the processes what we follow in the commercial undertakings or manufacturing sectors or service sectors. And for evaluating the financial performance of this business organization or agri-business organization, we use different financial statements or financial ratio, like the balance sheet, the income statement or cash flow statement. So these are the financial statement. Basically they indicate the financial strength of a business organization. So basically in this session, basically we will be focusing on the balance sheet, the meaning of the balance sheet, the component of balance sheet, the utility of the balance sheet, and how to prepare the balance sheet. Like many agriculture projects which include the industrial component in it, like rice mill, dal mill, fruits and vegetable preserving, canning plant, the milk processing plant. So they are basically having the industrial component, and the financial analysis of this industry is similar to the other industries. So the project analyst in such cases, which basically agriculture project which having the industrial component. So in this cases, basically the project analysis is concerned about the analysis of the financial statements, like the balance sheet, cash flow statement, income statement, to judge the profitability of the organization, and the liquidity positions, the how much money is available to meet their expenditure requirement, the financial soundness, the credit worthiness of the projects. So actually if we want to judge the profitability, liquidity positions, or the financial soundness, or the credit worthiness of the organizations, we need to have the different financial statement, like balance sheet, the cash flow, and the income statement. And the balance sheet is the most commonly used financial statement, and actually which is commonly used by almost all the types of organization. So basically balance sheet shows the firm's financial positions as on a specific date. So it shows the financial strength of a company or a firm on a particular date, and basically it includes the assets a firm is own, or the capital a firm have, and what are the liabilities that is to be paid to the outside organization. So liabilities, so there are these three components in the balance sheet: assets, capital, and liability. And generally the balance sheet is prepared at the on the last day of the financial years, that is 31st March, but it can be prepared on any date of a year. Sometimes we can prepare on the quarterly basis the balance sheet on 30th June or the 31st December. So like that we can also prepare the balance sheet. And actually in the balance sheet it shows the money what owns, what are the different capital or assets or cash a company, a firm is having in the business, and what owes. So, what are the different things it has to be paid to the other organization outside the it has to give to the other organization, and also it shows the investment by stakeholder, the firm's contribution, the stakeholders contribution in the the resource of the that firms or organization. So, basically the balance sheet provides the basis for calculating the rate of returns or evaluation of the capital structure, and basically it is the balance sheet is used in calculation of the financial ratio. There are various financial ratios. So, for calculating this financial ratio we need to have the balance sheet, and when we prepare the balance sheet there are two format available, and the common format is that in the assets is reflected is showed on the the left hand side, and the liability are showed on the right hand side, and in two parallel column on the pages. So, in the left hand side there is a the assets, and on the right hand side there is a liabilities in a page. And the another format is the that is also called the vertical balance sheet, and in that the assets are shown on the top of the page, or liabilities on the bottom of the page, or reverse is also possible. We can show the liability on the top of the page and the assets on the bottom of the page. So, that is basically vertical form. And again the basically the balance sheet is very standard format, and the assets and liability plus equity are defined in such a manner that they must always be equal. So, the formula we can say is the asset is equal to the liability plus owner's equity. So, whatever the a company or a firm is owned is basically the assets, and that assets is contributed from the liability and from the owner's equity. So, liability is the things or the resources we have taken from other, and that we have to give back to them, and the plus the owner's equity, that is the contribution of the firm from their own money reserve they have already with them, or it also includes the stakeholders or shareholders contribution in a organization. So in always in the balance sheet there is a balance between the assets and the liability and the owner's equity. That's why it is called as a balance sheet. So there are different components like assets and liability, two major components. So first let us understand what is the assets. So assets basically shows the things that a firm own. So what are the things a company or a firm is having or an individual having? That is basically his or her assets or firm's assets. So it is the assets are basically firm's properties or resources which has which have the future benefits for the company. So these assets are used in the production production activity, and there may be the different assets like purchasing powers. So and the cash or bank balance, whatever the company or firm have, that is basically assets, and the things or the money that is claimed to be received in futures, like book debt or stock of goods. By selling the stock of goods in the market, we will get something. So that's why the assets also, the goods also basically assets. So and the economic resources which generate revenues, that is like plants or machinery, they are also assets. Or the rights like the patent rights or copyrights and goodwill of the company, because they also give some value to the company or firm. So they are basically also assets. So these are the things we include in the assets. And there are three types of the assets. One is the current assets, and then we have the fixed assets and other assets. So fixed assets and other assets are also we call sometimes non-current assets. So we can say the current assets and non-current assets. So the current assets are basically liquid assets. So actually the assets which are in the form of the cash or which are easily convertible into the cash within a accounting period, generally within 1 year, that is called as a current asset. So there are different examples of current assets, the cash and bank balance, the whatever the money they have in hand, or whatever the money is deposited in the bank, that is basically the current asset. Then account receivable, the amount owed to the firm by customers or are expected to be converted to cash within a year. So suppose the company they have sold something to a particular person or particular customer, and that customer will be paying that money within 1 month or within accounting periods or within the accounting year. So that is basically current asset. So money is coming back within 1 year, and so that's why that is a current assets. Then inventories for prompt sale, whatever the stock is available for sale purpose, that is also in the current assets. And then we have the tradable investment of the short term nature, such as share, bank or debenture. So whatever the share a company is having, which can be sold in the market anytime, so that is also basically current assets. Then fixed assets or non-current assets we can say. So they are basically long-term assets, and the benefits of these assets are extended beyond a accounting period. So actually the utility of these assets is more than a year. So durable goods of relatively long lives, they are basically assets, and they are used by the enterprise in production of goods and services rather than to be sold, rather than to be held for the sale. So actually these assets are used in the production process. They are not meant for the selling as such. And the example of the fixed assets are the property, and whatever the properties or building, plants or equipments or land they have, they are the fixed assets. Like building and equipments are often shown in the at their original cost, and then the accumulated depreciation allowances are deducted. So by how to value this building and equipments in the balance sheets. So the one machine of the 1 lakh, so we have to include the original value of the 1 lakh, but we have to deduct the depreciation of that machine, whatever the value we calculate as a depreciation. And in case of the land, actually we never, as per the convention, we never depreciate the land. As generally we believe the value of the land will increase, so there is no depreciation in the land. Then other assets actually are, which are all those assets which cannot be classified as a current assets or fixed assets or investment. There are different examples, like expenditure which are incurred for a period longer than accounting period. So there are many investment, so it take more than a year. So so that type of expenditure on the creating assets, that is also called the other assets. Actually these are the assets which do not result in acquisition of assets, are referred to be deferred expenditure. So all these are basically other assets. Now we'll move to the liabilities, and basically the liabilities shows how much a firm owes to others. So actually the how much a firm has to pay to the other in a current year, in the years to come. So a liability is basically an obligation to pay cash or provide goods and services in the future, and a firm credit liability by borrowing funds or by acquiring goods and services on credit. So if a company borrows money from a bank, it creates a liability. Basically it is to be paid back to the the bank. If a company buys raw material on a credit, it create a liabilities because he has to pay the value of that raw material to the persons or to the company from where he has purchased on. So basically it is a obligation to money in the future. So all the money which has to be paid in the future, that is basically liability. And liability are of two kinds. One is the current liability, another is the long term liabilities, or sometimes non current liability we call them. So the current liability basically is the debt or obligation that is payable within a accounting period. So within a year it has to be paid. So all the liabilities which has to be paid within a 1 year, that is called as a current liability. So generally they are paid off from the cash generated from the operations by the conversion of current assets. So whenever we convert the current assets, and that is used to pay the liability, so that is basically current liabilities. And there are different examples of the current liability, like account payable, like we have purchased some raw materials and which has to be paid in a current years or current financial years. And the short term loans which are generally paid within a 1 year, and then provision of the tax, whatever tax has to be paid to the government within a accounting years, that is also in current liability, because we have to pay something to the government as a tax. Then the current portion of the long term loans, like we have taken a long term loans, so whatever money we have to pay within a 1 year or within a accounting year, that is also a part of the current liability. And suppliers credit, that must to be paid within a accounting year. So when we are getting some resource from the supplier or some input from the supplier, and then for that we have to pay within the current year, that is also basically the current liability. Then we have the long term liabilities, and the long term liability is basically a debt or obligation that is payable after a year from the date of the balance sheet. It's called a long term liability. So all the things which has to be paid after the date of the balance sheet, it is basically long term liabilities. The long term liability may consist of medium term loan, long term loans, or the supplier's credit. And loans may be from the financial institution, loan may be from the financial institution or from the public in the form of the bond or debenture issued by the firm. So not only the loan, but the bonds or debenture which are issued by the company or firm, that is also basically long term liability. And then the third component, the balance sheet, is the owner's equity, that we also call as a net worth. And basically owner's equity consists of the claims against the assets of the enterprise by its owner. So whatever the contribution a owner of the firm, a owner of the the company is contributing in terms of the assets, in terms of the shareholding, in terms of his own resources, that is called as basically owner's equity or net worth. And the owner's equity could be found by taking the difference between the total assets and total liability of the firms. So if you want to calculate the owner's equity or net worth, we have to simply do simple mathematics. We have to minus we have to reduce the total liability from the total assets. So it is basically important determinants of the value of the firm. So actually how much owner's equity, how much net worth of a firm is there, that determines the value of the firm. So in basically net worth or the owner's equity is consist of all the money invested since inception and also retained earnings. So whatever the money which have been invested by the owner of the firms or company, and whatever the earning or income which have been retained in the business or in the firms or in the company, that is also part of the owner's equity or net worth. So basically it is used to determine the credit worthiness of the firm. So, if a firm has a good amount of the owner's equity, and that is considered a is having good credit worthiness or good worthiness of the firm. So, basically it gives a snapshot of the firm's investment history, like the owner's equity, shareholder equity or net assets. So, based on the owner's equity, we can find out the the history of the investment of a firm. So, how much in the contribution from the owner of the firms, or how much contribution from the shareholders, and how much they have generated the assets in the company or firm. So, that gives a kind of credit worthiness of the firm. Now, here we can see the examples, so how the different forms of the different forms of the the balance sheets are there, and the format is basically the left hand side we have the assets, and right hand side we have the liability and equity. We call it in a horizontal form sometime, and here it is shown as on 31st March 2020, and that is the end of the financial year, and the amount is given the rupees. So, in the asset sides or left hand sides, you see there is a current assets, the fixed asset and total assets. So, in case of the current assets, we have included the cash and bank balances, which is amounting rupees 12,000, and then account receivable. So, actually account receivable means the products which have been already been sold, and we will be receiving that payment of that quantity or amount sold in the market. So, in that is here 68,000, and the inventories, the stocks of the metal which is available in the firm, so in a company. So, that is 1,67,000 here. So, total current assets here in this balance sheet is 2,47,000. And now we will move to the fixed asset. So, fixed asset here we have included the land and the building and equipments and construction which are in the progress. So, land value here we have given the 50,000, and then building and equipments we have given 3,50,000. Then the construction which we have already completed, that is around 50,000. So, total assets, fixed assets here is 4,50,000, and the total company assets of a dal mill here is 6,97,000. Now, we will move to the right hand side where we are showing the liabilities and equity. So, first we will see the current liabilities. So, here again the account payable, that is 47,000. So, we have purchased some raw materials or some other things, and for that we have to make the payments, that is 47,000. Then short term loans 6,000, we have taken some short term loan from bank or some other, that is amounted to 6,000. Then long term loan and current portion. So, we have taken a long term loan from the SBI, that is so out of that current loan, long term loans we have to pay the 15,000 rupees in this particular year. So, that 15,000 is basically part of the current liabilities. And then suppliers credit 5,000 rupees there. So, total current liability is 73,000, and now we will move to long term liability. So, we have taken a long term loan from the SBI, so that has to be paid 65,000 in this particular year, and then suppliers credit is also 15,000. So, total long term liability is 18,000. And now we will move to the equity. So, share capital, that is 4 lakhs rupees, and then capital surplus, the money we have already reserved the capital, that is 1 lakhs rupees, and retained earning. So, profit we have earned earlier, so we have already invested in the company, that is 44,000. So, total equity is here 5 lakhs 44,000, and when we plus this the owner's equity or total equity of the 5 lakhs 44,000, and with the total liabilities, long term liability and short term liability, then it become a total liability plus equity become a 6,97,000. So this 6,97,000 in terms of total liabilities and equity is equal to the total assets, that is also 6,97,000. So here basically in the balance sheet we have to make a balance, the total assets should be equal to the total liability and equity. So actually, so this equity of 5,44,000 so the financial strength of a company, of a firm. So here in case of the dal mill, we say the dal mill is having the resources reserve in terms of his own capital, in terms of the shareholding, in terms of the retaining the earning, that is 5,44,000. So this is the positive balance. So it shows the good health of the dal mills or a organization as on the 31st March 2020. So that was the basically horizontal or the right and left side format of the balance sheet. Now we will move to the vertical format of the balance sheet. So suppose we have some data of financial data of a firm on 31st December 2019 and we want to calculate, we want to prepare a balance sheet as on 31st December 2019, and some data is we have calculated in the firms or organization, like cash rupees 2,000, the patent 1,000, debtor is the debtor is 4,000, the creditor is 3,000, tax payable is 1,000 rupees, the machinery 17,000, bank loan is 7,000, retained earning is 3,000, and capital stock is 10,000. So this from this available data we have to prepare, and our objective is to show how to prepare the balance sheet in the vertical format. So while preparing the the vertical form, first we have to show the assets. So current assets, the fixed assets. So in terms of current assets, we have the cash of 2,000 rupees and the debtor of 4,000 rupees. So current assets is 6,000 rupees. Then fixed assets, we have the machinery which have the value of the 17,000, and then we have the intangible assets in terms of patents. So that have the value of 1,000. So total assets of the firm is 24,000. Now in the lower or bottom of the page we will prepare the liabilities. So here we have the current liabilities of creditor of rupees 3,000, then tax payable within the accounting period is 1,000 rupees. So current liability is 4,000 rupees, and non-current liabilities like bank loan we have the 7,000 rupees. So total liabilities here is 7,000 plus 4,000, that is 11,000. So and then the stakeholders equity or net worth of the firm is so capital stock we have the 10,000 rupees and retained earning is 3,000 rupees. So total the equity is 13,000. So this the equity of 13,000 plus the total liability of 11,000, that become a 24,000, and that 24,000 is equal to the total assets of 24,000. So in this way the total assets is equal to the total liability plus the stakeholders equity. So that is the basically the vertical format. So here now this is the actual worksheet of the CRIPCO which is available in the annual report of CRIPCO for the year 2018-19, and this this is the vertical format of the the balance sheet that was as on March 31st 2019, and here they have used this reverse type. First they have shown the equity, then liability, and then the assets. So in the top of the page, first they have shown this the equity. So they have shown the shareholder fund, then the non-current liability, then current liabilities, and then here total there are different items in different, the shareholders fund, like they have the share capital, reserve surplus. In case of non-current liabilities, they have deferred tax, the other long-term liabilities or long-term provisions. In case of the current liabilities, short-term borrowing, and the trade payables, the other current liabilities, short-term provisions. So total, the equity plus liability is the amount is given in the rupees lakhs. So total of the equity plus liability is the 9,69,659 lakh rupees. So in the bottom of the paper, bottom of the page, they have given the the assets, and so assets here, there is a non-current assets. So in case of non-current assets, they have the fixed assets like properties, plant, equipments, the capital work in progress, intangible assets, and so non-current investment, the long-term loans and advances, and other non-current assets they have included. And then current assets like inventories, the material available for sale, the trade receivables, the cash and bank balances, short-term loans, advances, the other current assets. So total of these assets, they have become the and again the 9,69,659 lakh rupees. So here again the equity and liability, the total of the equity and liability is equal to the total assets. And here in case of the companies or organization, for each items, they have prepared a separate schedule. That number is also given, which can be referred how this figure have arrived. So that calculation is also given. And here in the bottom of the the balance sheet, you will see the accounting process is also mentioned. So and the policy of the company in calculating the balance sheet is also mentioned. So for that, the separate schedule or note is given. Now we can sum up this session that the many agriculture projects have the industrial components, and the financial analysis of this project is to be done as per the industrial projects. And we need to prepare the financial statement, and the balance sheet is widely used financial instrument to assess the strength of the project. And the balance sheets basically shows the statements about the assets, capitals and liabilities of the firms on a specific date. Generally we prepare the balance sheet on 31st March. And basically this balance sheet is used to calculate different financial ratio to show the company's the financial health, the financial soundness of the company or firm. With this, I thank you. Thank you very much.